Well, hi, everybody. Good morning or good afternoon, depending on where you are. Glad to have you with us today. My name is Garrett Schmidt, and I'm the managing editor for VBC Exhibit Hall. And I'd like to welcome you to today's live webinar hosted by Summit Re. And this is the part two of a two-part series called Don't Let Downside Risk Get You Down. It's effectively right sizing your risk exposure part two. And it's okay if you haven't heard part one yet. That's not going to make this confusing or have you be lost, but we'll definitely include a link afterwards or at some point to where you can go back and review and watch part one if you would like. Hope that you do that. Couple notes before we get started. Everyone's joined today in listen only mode. This is a traditional webinar format, so we can't see you or hear you, so don't worry about that. However, as usual, we do want to hear from you. So we're going to have a time for some Q&A towards the end. And so if you have a question that at any point during the presentation, you can ask it using your control module. You have a little attendee module that's going to be on your screen, which you can drag around. You should be able to move around if it's in your way. But one of those things will be questions, and you can go ahead and drop your question right there, which is different than the chat. So make sure you put that in the right place. And we're going to get to as many as we can during the allotted time. If for some reason we don't get to yours or we're not able to, we don't run out of time, don't worry, someone will reach out to you via email afterwards and make sure to answer your question. So even if we're wrapping up at the very end, go ahead and ask your question. And then finally, we are recording the session today as usual. So what's going to happen is when we're done, maybe about an hour or so after the presentation, you'll receive an email, and it will be it'll include a link to the recording as well as where you can download the slides and learn a little bit more. Also, there some other materials about Summit Re and what they're doing. So, without further ado, I'd like to briefly welcome our speakers and introduce them. We have Mr. Rick Lasso, who's Vice President of Underwriting and Actuarial. So welcome, Rick. And we also have Scott Mahout, and he is the Vice President for Sales for Reinsurance and Provider Excess. So welcome, gentlemen.
Very good. Well, thanks, Garrett. Much appreciated. And to everybody on the line, thank you so much for joining us for part two of Don't Let Downside Risk Get You Down. I'd like to just make a couple opening comments to provide some context for this presentation. So whereas our first webinar was really more of a 101 for providers that are contemplating taking risk or perhaps considering taking more risk, today's session is going to focus on how to actually obtain a quote or an indication for provider excess insurance coverage. And we're going to include an overview of the underwriting process, discussion of the RFP components and data requirements, coverage considerations. Rick will talk about underwriting analysis and pricing methodologies, and we'll also touch on some of the unique considerations for ACO REACH participants as well. So before we begin, I'd like to just recap a few key takeaways from our first webinar, which was more about understanding the risk and how CMS continues to be a catalyst for value-based care risk sharing. We mentioned that risk sharing initiatives include all product lines, so inclusive of commercial business, Medicare, and Medicaid, and also that there's numerous different types of provider organizations that are taking on risk, both from an upside risk and a downside risk standpoint, and that downside risk is very real. And as an example of how real that risk is, we talked about how cell and gene therapies ranging from $2 to $4 million per therapy are bringing a whole new level of volatility to the industry, particularly in the Medicaid line of business. So why don't we go to the next slide. Actually, one last thing I wanted to mention, of course, the good news to what I just said is that downside risk for provider organizations certainly is insurable. And it's insurable either on a specific or aggregate basis or both. And today's discussion is going to focus on how to go about obtaining the provider excess coverage for specific excess of loss. So why don't we go ahead to the next slide, which is really, we'd like to start things off here with a poll. It's a brief poll. So if the question here is, what level of risk are you currently taking? And we'll give everyone 30 seconds or so to go ahead and mark your response. So the responses here are upside only risk, upside now, but transitioning to downside in the next 6 to 12 months. I'll only take downside risk when they make me. I'm all in, bring on all the risk, or none. This is not an applicable question for me. So we'll just wait. Garrett, you can let me know when you think we've tallied everything up.
All right, so I've put the question up. So this is a select one only. So go ahead and make your selection. And we've still got results coming in, so we'll give it a few more seconds here. And of course, this is anonymous, so and we will share the results, so you'll be able to see kind of where you stand among your colleagues. So we'll show these results here in just a moment. And it looks like most of the results have come in. So I'm going to close it down in about 5 seconds. 4, 3, 2, and 1. And then I will show the results here. Okay, so, all right. Scott, are you able to see the results here?
Yes, yes, interesting. Looks pretty split, except for the last category. Very, very interesting. All right, great. Well, this is helpful. This is very useful. It's going to help us tailor our color commentary for the remainder of the webinar. Why don't we move on to the next slide, Tammy? Okay, thank you. So, so provider access loss, the underwriting process. This is just a high-level overview of the underwriting process. As you see, it begins with a licensed insurance agent submitting a request for proposal to the insurance carrier, or in some cases, the carriers have a representative, managing general underwriter that does the underwriting. But as I mentioned in the first webinar, since provider excess coverage is actually an insurance product versus reinsurance, it is necessary to have a licensed agent solicit the request and present that request to the carrier. Next, the experience and the coverage terms are entered into the rating models, and then the results are blended to determine the rates, which are expressed on what we call a PMPM basis, so that's per member per month. And then lastly, a formal proposal is generated for the agent to deliver. So again, this is just very high level, but thought it would be useful to level set at the front or up front here what the underwriting process is. Next slide. Okay, so now we're going to get a little bit more into the weeds and walk through the various RFP components and why they matter on the next few slides. So the type of organization is obviously very important. We need to know who we're dealing with, whether this is a hospital system, an ACO, an independent physician association, or group practice. So we'll need to have the type of organization identified. Contracting information, very important. In our first webinar, we introduced this notion of a DOFR, which is a division of financial responsibilities. And that's a very, very detailed agreement between the provider and the payer, essentially laying out, like I said, in great detail, who is going to be responsible, which party is going to be responsible for what. And then the coverage being requested based on the risk that the provider organization is taking doesn't mean they have to insure all of that risk. So we'll want to know, do we want inpatient covered, outpatient services, physician services, drugs, etc. And then the next few bullet points here, as far as historical information, ideally we'd like to be able to see 4 years of claim detail and 4 years of historical membership by month. So you can see for the claim information, we would like to see that by year. And when I'm referring to we, I'm using we in the general term as far as any entity that is going to be doing the underwriting here. So we'd like to see the claim detail by year and by line business for claims that are greater than 50% of the requested deductible. And then for the member months, the historical member months, we would like to see those by month and by line of business. Next bullet point is the tertiary care services. So this is also quite important. This is going to identify key facility names and the contracted rates, and also specifically identify services that may not have a contract. So as you can see, as we go down this list, this is really trying to get to as precise as possible the coverage that's needed, historical experience and historical membership that has generated the experience, and also some of the facilities, the guardrails that might be put around this risk as far as contracted rates, as well as any maximums, which we'll get to in just a minute, any maximums for costs that might be applicable as well. And the last bullet point on this sheet talks about, or on the slide, mentions non-tertiary care services. So to the extent you're aware of this information, we can get a summary of contracted facilities and rates when known for non-tertiary care services. That's quite useful as well. Next slide. Continuing on here, again, to give us an idea of utilization and cost per day, we'll ask for this information for the past 3 years by member type. So again, this continues to give us, if you think of each one of these as a color on a palette, and we're from the underwriting process trying to paint the picture, if you will, which ultimately results in their proposal. Each one of these represents something that is very useful for us for purposes of being as accurate as possible when we develop the proposal. Non-network services. So this is also quite important. So this represents a percentage of non-network utilization for hospitals and professional services. So this is oftentimes, these are the claims that leak out of the network, the non-domestic claims. And the reason it's important for us to obtain this information is because oftentimes these can be the most expensive claims because the provider organization has less, or in some cases no ability to really manage manage where those costs are going. And then the last 3 items here, the medical management. These are a little bit more anecdotal. We'd like to have some description of the case management programs that the provider organization has in place. If the provider already is, if there's already a policy in place, a provider access policy in place, we'd like to get a copy of that policy for the last 2 years, along with any applicable recovery reports. And then also, if you're aware of any material changes in the risk over the last couple of years, we would want to have that information disclosed as well. So I know on these last couple of slides, there was quite a bit of information that we're requesting. Some pieces of the information are required as far as experience and contract related matters. Obviously the type of coverage that's needed, deductibles, etc. We'll get into that a little further down the road. But this really, it's designed to be a wish list. It doesn't mean that we can't offer a quote or an indication if we don't have all of this information, but as you can appreciate, the more data, the better. So the more information that we can receive to have a very clear picture of what the exposure is and what the risk is, the more accurate we can be in our pricing. So why don't we move on to the next slide, Tammy? So these next few slides talk about considerations for coverage. So these are things that, when designing the insurance coverage or determining the insurance coverage, we're going to want to take into consideration. So obviously we want to know the covered members. Which population types is this going to cover? Is it going to be commercial, Medicare, Medicaid, all of the above, or just a few? Covered services, I alluded to this earlier, based on the Division of Financial Responsibilities. That outlines the covered expenses, which are could include inpatient, outpatient, physician services, drugs, etc. So again, that's very key. And then the deductible, obviously, this is going to be how much the provider organization, based on their risk tolerance, is willing to retain. And when we go through the quote process, there doesn't need to be just one deductible selected. Oftentimes there's multiple options that we provide, and we will also, or the underwriter, the organization doing the underwriter, will also suggest some appropriate deductible levels based on their experience. So during the discussion, as you're going through this process, thinking about considerations for coverage, I would definitely want to make sure that you consult very closely with the underwriter to see if they would be willing to offer some some appropriate deductible levels as well. Next slide. So maximum allowable charges. This varies at the case level, and when I referred earlier to some guardrails being put on the risk, these are a few examples of those. So there might be an average daily maximum involved, per diems, case rates. Those are all things that we're going to want to be aware of for purposes of understanding how much, what the maximum allowable charges are for certain procedures. The standard liability period, these provider excess insurance policies are annual, typically annual policies, but the liability period may extend beyond the first 12 months. So the way that this is typically stated is that the policy is written on for example, a 12, 18, 19 basis. And that means that the expenses are incurred in the first 12 months, actually paid in the next up to 18 months, and then reported reimbursed within 19 months from the start of the policy. So it's a 12, 18, 19. There are some other options that we've seen requested from time to time. We've seen 1224, I've seen 1236, which we don't see that too frequently, primarily because of the cost, given the significant lag in the ability to report claims. And we've even seen some 1215 coverages. So it really depends from an operations standpoint how the provider organization is set up. Premium rates, I don't know if this is really a consideration for coverage, but we thought it was important to include here just to reiterate that the rates are going to be displayed on a PM basis. So that, again, that's per member per month. And then there's an experience refund option that is available. The surcharge for that is typically in the 2 to 4% range. But what this allows for is it's an optional elected benefit, as you see here, which allows the provider, to the extent that they have good claims experience, to receive a portion of their premium, to have a portion of their premium return based on that good experience. Next slide. And just a few more considerations for coverage here before we get into the underwriting analysis. This first item, the deductible carry forward. I love this feature. This basically says that because there is a single deductible, let's say it's $300,000, which is a pretty significant deductible. If there's a claim that happens in the last month of the year, for example, there may not be enough time for expenses to aggregate towards that $300,000 deductible. So what we'll do is we'll allow, and most insurers will allow, what they call a 31-day or 30-day deductible carry forward, where any expenses that are incurred in that last month of the year can be rolled forward and be applied to the deductible in the subsequent year. Coinsurance, this is the amount that the carrier is going to pay after the applicable deductible, and also the amount that the provider will keep after the deductible. So you might be asking yourself, well, if there's a deductible, why would the provider also have to keep another 10 to 20% of the risk once it gets over that deductible? And the reason for that is because we want everybody's interests need to be aligned, and the underwriter wants to make sure that the provider still has an interest in effectively managing the costs associated with that claim even after it gets to the deductible. So it's very typical that the coinsurance is, 80 or 90% for the carrier, where they're retaining 80 or 90% excess of the deductible, and the provider will keep an additional 10 to 20%. And then lastly, the maximum benefit per member per year. This is very important. Again, and it varies at the case level. So you can, in accordance with the ACA, the underwriter can provide unlimited coverage, excess of the deductible, or if they want a less expensive option or two, they might choose to, the provider organization might choose to limit their per person exposure to $2 million or $5 million. So there's a lot of moving parts here, and what I think is most important to know, again, this is before I turn this over to Rick and we get into the underwriting analysis. There's a lot of different things to consider. It's best to work with the underwriter as much as consultant and advisor in trying to set appropriate deductibles, so there's not what we call a lot of dollar trading going back and forth. You don't want to have the deductible set so low that there's going to be a fairly significant number of claims, because it doesn't do any good for the provider to pay $1 in premium and only get 80 cents in claims back if there's going to be high frequency. So from an excess standpoint, our goal is really to set those deductible levels where maybe you would have 3 to 5 to 7 claims per year as opposed to 10 to 20. So there's a lot of different options here, and in the proposals that are issued, there generally will be a number of options to consider: different deductible levels, perhaps different coinsurance percentages, different maximums per member per year. So a lot of moving parts, but it's important as you go through your own risk evaluation process that you really have a good idea of what your options are, and make sure you can marry those choices up well against the organization's own risk tolerance. So now I'd like to turn it over to Rick. He is going to talk about underwriting analysis, the pricing methods, and again, as I mentioned earlier, some unique considerations for the HCO REACH participants that might be on the call, and also a few comments regarding how to address capitation. So Rick, take it away.
Thank you, Scott. What I'd like to do today is just share a little bit about what happens after a provider submits a request for a proposal. What is the underwriter doing with all of that information? Why is all this requested information so important? And I won't go through each of the bullets on this slide. I'm going to focus on a few. One is the fourth, which Scott began talking about just a minute ago, the appropriateness of the deductible requested. For those who were on the first webinar, this graphic on the right may look familiar. As Scott mentioned, if the deductible is too low, then the insurer is going to end up paying a lot of claims. If you expect to pay a lot of claims, you're going to price the insurance at a higher cost. There's a margin associated with that, and so it's not really in the benefit of the provider to purchase too much coverage, because you're paying that reinsurance margin, you're paying that insurance margin for that coverage, and it doesn't make sense to have that apply to too many claims. So in order to right size the insurance spend, often one of the first things the underwriter does is plug the data specific to the case into the rating model and look to see, hey, does it look like this provider is requesting a deductible that makes sense? And referring to the graphic on the right side of the screen here, this is illustrative data for an insurance company. So not a provider, but an insurance company. Each of the bars, each of the blue and green bars, vertical bars, each of those represents one catastrophic claim. And you can see the scale for that on the left-hand side, ranging from 0 to 4 million. And then of course on the rightmost bar is even off the chart. That's a $10.6 million claim. That's a very unusual catastrophic claim that this insurer experienced in 2021. So if that insurance company was purchasing reinsurance, we would probably recommend that they purchase at a deductible level of about $1.5 million. There's a horizontal line about a third of the way up the chart at $1.5 million. And the reason for that is that only about 4 or 5 claims are exceeding that $1.5 million level. Now, in reality, we'd be looking at more than 1 year. We'd be looking at 3, 4, 5 years of history. Yeah, I mean, maybe this was an unusual year. Maybe there's 4 claims this year, but maybe in a normal year there's 10 claims, or maybe in a normal year there's 0. So of course we want to look at a few years and see what's normal, and that helps evaluate. Okay, does this coverage even make sense? Once we figured out, oh, okay, and so this is for an insurance company, of course. Now for a provider, the provider's slice is represented by the horizontal shaded area, A and B, for example. So this insurance company might be delegating risk to a couple different provider systems that they participate with. And provider A on the left would only get a slice. So they would only get because they only have a slice of the risk, they're also likely to only have a slice of the catastrophic claims. So you can see that both providing this example, both provider A and provider B, they each get about 5 claims of catastrophic, 5 catastrophic claims. But because none of those 5 claims in this example are above $1.5 million, they would have 0 claims above $1.5 million in this example. So perhaps a more appropriate deductible for a provider in this situation would be something lower, like $500,000. So again, that depends on the size of the provider, depends on what part of the country you're in, depends on the nature of the contracts, and so on. So that's the first step, is how reasonable does this look? And by the way, to get that, these claim amounts, as we all know, healthcare costs do increase from year to year, and they tend to increase faster than general inflation. So one of the things the underwriter needs to do is apply these inflation factors. We call them a trend adjustment. We apply these trend adjustments or inflation factors to this historical data to get it on a basis for the contract period. So if an underwriter is quoting a 2024 insurance coverage, the underwriter would take all the historical data for 2019, 2020, 21, and so on, and apply an inflation adjustment to get that to 2024, so that everything's on an apples to apples basis. Could you go to the next slide, please? Once we've determined, okay, here we're comfortable with what we're, with the coverage that's being requested, the underwriter essentially has 2 tasks in front of them. The first is to take that experience, the historical experience that they were just looking at, and blend that together into what's called an experience rate. So the underwriter might look at 2019 and say, okay, in 2019 the cost was $6 per member per month for the actual catastrophic claims in 2019. But for 2020, maybe it was a little higher, and for 2021, maybe it was a little lower. So that all gets blended together into what we call an experience rate. Now, that experience rate, there's definitely a component of luck in there. Like it could be good luck, it could be bad luck, and so it's not appropriate to just build up a rate based on experience unless it's a very large entity that's being insured. Most of the time, since we're talking about catastrophic claims, and there's only a few claims a year, you really need to bring in the concept of a benchmark rate. And in the industry, we call this a manual rate, which doesn't mean that we do it by hand. This harkens back to the days when, before there was a computer model doing all this, helping us with all this analysis. There was actually a book, a rating manual, which was a book, and you would page through and look, you have a table and look down and say, okay, they're 600,000 member months and deductibles $50,000, and you'd look up what the rate is. So we call that a manual rate. Really, it's just a benchmark. So what would a national benchmark be? Having come up with each of those rates, then the underwriter will weight them together. We'll get to that in a minute. So for the experience rate, it's just looking at the company's own data, the provider's own data. For the manual rate, this is where some of that information on facilities is very important. So if a provider has most of their catastrophic claims at higher cost facilities, then they're gonna be quoted a higher rate than if they are if most of their catastrophic patients are admitted at lower cost facilities. And we're focusing on facilities here because for the most part, catastrophic claims are still driven by hospital inpatient admissions. There is an increasing percentage of large claims that are drug-based. And, we talked about gene therapy on the first webinar, but that's still a minority. It's still a minority of catastrophic claims. Most catastrophic claims are really driven by inpatient stays. So it's very important what hospitals those claims are likely to be at, and it's important what the payment rates are there. What's the discount? Now, from a provider's perspective, they may or may not know what those discounts are. So sometimes the underwriter needs to make assumptions. So it all depends on the nature of the arrangement with the payer. Having come up with an experience rate and a manual rate, then the next step would be to blend those together, and that's called a credibility weighting. So if the provider is small, maybe the experience would only get a 10% weight and the manual would get a 90% weight. Or on the other hand, if the provider is large, maybe the experience would get a 50% weight or even a 60% weight. It usually doesn't go much higher than that for providers. Next slide, please. Having blended those together, the experience rate and the manual rate, then the underwriter has what they believe to be an accurate prediction, hopefully accurate prediction, of what the true large claim risk is in 2024 for this provider. The underwriter adds a provision for expenses and for profit. So this is as mentioned before. This is why you don't want the deductible to be too low, because it's not, in an average year, the insurance is not likely to be a profit center. In an average year, there's likely to be a little bit of a loss because you've got these expense and profit margin. The goal of the insurance is to pool the catastrophic claims so that in any year, so there's financial stability from year to year. So in any particular year, if there's catastrophic losses, those don't flow to the provider's bottom line or flow through to their risk-sharing arrangement with the payer. Now, I will say that provider access insurers can and do also often have services to assist provider clients in reducing cost, because both parties have a shared interest in reducing cost. So that sometimes there may be vendor relationships available, or there may be, it could be that the care management staff or the claims staff at the insurer have seen a case like this before, and may be able to work with the provider's own care management staff to assist where that's helpful. But the primary goal is pooling claim cost as described. Next slide, please. One challenge that can arise in developing the manual rate and the experience rate is how should we value these services when it's a fully capitated arrangement? So we talked in the last webinar about the spectrum of value-based care. On one end of the spectrum, on the lighter end of the spectrum, is essentially a fee-for-service arrangement with perhaps a settle up at the end of the year, maybe with some quality bonuses. In that situation, every claim has an assigned paid amount, and that paid amount could be compared to the billed amount to calculate a discount. So you can identify the facility, you can identify the discount, you know how much it's going to cost. For a fully capitated arrangement, particularly for claims that are paid at the provider's own facility, for claims that are for services that are rendered at the provider's own hospitals, there may not be a paid amount because they may not be paying themselves. And so the question is what value to assign to that. Often, especially if it's a Medicare population, you might just assign 100% of Medicare or something similar. If it's a commercial population, you might assign, okay, let's put 50% of bill charges or 40% or some percentage of bill charges. It also might be the case that the provider isn't that worried about catastrophic claims at their own facilities because they have more control at their own facilities, and because they're unlikely to in some cases, the catastrophic cases may be referred elsewhere. So there might not be as many catastrophic cases at their at the own facilities. So one option is to carve out domestic claims. When they're not carved out, another common option that providers consider is if they're maybe a little bit less worried about their own facilities, but they still want some coverage, would be to have a lesser coinsurance. So for example, perhaps only a 50% coinsurance would apply to claims at domestic facilities. Next slide, please. Before wrapping up, I wanted to touch on a few unique considerations for the ACO REACH program. So one is that, well, first of all, the ACO REACH program is unique among the Medicare ACO programs in that the CMS stop loss program is optional. The other ACO programs, MSSP and some of the older programs like the Pioneer ACOs and all them, they had a mandatory truncation point or a mandatory stop loss program. ACO REACH is different in that program is optional. In the first couple of years of the program, the DCE program, as it was known, that mandatory stop loss program was similar to what you would see in the commercial insurance market, where there was a fixed deductible and CMS would truncate claims above that deductible, above that fixed deductible. In that situation, often the CMS program was a good option. The type of situation where a provider might want to decline the CMS protection and instead go to the commercial market would be typically it would be if the provider wanted to assume or retain more risk than the CMS deductible would provide for. So as an example, if the CMS program offered a deductible of $170,000 and take it or leave it, some providers would say, I'm comfortable managing to a higher risk than that. That'd be comfortable risking, managing to 250 or 400. And so the provider could retain the risk, retain the ability to achieve shared savings on that on claims up to say $400,000, but then still purchase protection above that $400,000. Another reason that providers might have considered purchasing commercial coverage would be if they have multiple risk-sharing arrangements. They might have a risk-sharing arrangement with the ACO REACH program with CMS, and they might also have commercial risk-sharing arrangements. And some providers see a benefit in combining that into one program and having a single stop loss program that applies to all. Starting in 23, this year, so with this performance year, the CMS program did become more complicated. Instead of assigning a single deductible, say $175,000, they essentially are assigning a different deductible to each beneficiary based on that beneficiary's health status. So that, of course, makes it quite a bit more complicated to administer and track. So we have seen more providers interested in commercial stop loss since that change. Data availability, there's pros and cons here. So on the one hand, CMS provides a consistent data format. So that makes the underwriter's life a little bit easier, and it also makes the provider's life a little easier because for the most part, all they have to do to request a quote is to pass along the information provided to them by CMS. On the other hand, that CMS data format is not always providing all the information that the underwriter would like to see, particularly for newly aligned beneficiaries. And then finally, a unique consideration for the ACO REACH program is in the inpatient claim assignment. There can be a mismatch between how claims are assigned by CMS to a performance year and how a commercial insurer will assign claims to that commercial insurance contract. And in particular, this comes into play when a hospital admission crosses calendar years. So as an example, if you had a patient who was admitted in November and stayed in the hospital for 4 months through the end of February, a provider access insurance policy would typically either split that claim into two and say the first 2 months of the claim were in the prior insurance policy, and then the second 2 months, January, February, were in the the second year insurance policy. Or an option that is commonly seen is you attribute the entire admission to one policy year based on the admission date. So because that patient was admitted in November, the entire 4 months would be attributed to the first year's insurance policy. That's different than what CMS does. CMS assigns admissions based on the discharge date, and that my understanding is that's primarily because they don't want to have a long runout period. They want to be able to close the books on the performance year sooner. And so by allocating based on discharge date, you avoid the issue of having an open admission that would extend the runout period. So it makes sense what they're doing, but it's unique compared to most the way most insurance is structured. So one question to ask would be, if you're shopping for provider access coverage, is that insurance policy aligning with the risk you actually have? Is it aligning with that discharge date basis, or could there potentially be a mismatch? And that's not, that's up to the provider to decide if that's acceptable. But the answer could differ depending on the situation. Next slide, please. In summary, we talked about how data is key. We talked about tailoring coverage to risk tolerance. So this has to do with, what's the appropriate deductible level? How do you treat claims at your own facilities? We talked about the pricing approach, hopefully provided some insight into why underwriters need all this information. It's the blend of a benchmark rate with an experience rate. We do see growth in this market in ACO REACH. It seems like, well, I understand there's a moratorium for 24 on new entrants, but that program has grown every year, and we do see an increasing interest in provider access coverage among REACH ACOs because of CMS's changes. And then just, important to know that there is an opportunity for those providers that are interested in provider access coverage. There's no cost typically associated with obtaining a quote. So for those who are interested in that, know what that option is out there. I'll turn it back over to our moderator and for any Q&A.
All right. Well, there's a lot here, and there's a lot of material to review. So don't worry, we're going to make the recording and the slides available to you, so you can have some time to review that and share that with your colleagues. But we did have some questions that came through, so we're going to get to as many of them as we can. Go ahead and ask them now if you got them. Okay.
Garrett, I don't mean to interrupt. This is
yes,
Scott. Sir. Just one last thing that I wanted to mention before we get into the Q&A is the turnaround time for purposes of obtaining a provider access quote. It's typically 10 business days from the time complete underwriting information is submitted. So wanted to make sure everyone was aware of that it doesn't take months to get a quote. Once the data it has been submitted, to the extent it is complete or mostly complete, it's usually a 10 business day turnaround time.
Okay, yeah, that's great. All right, we do have a bunch of questions here, so we're going to get to as many as we can. First question, in no particular order here, is there a minimum number of covered lives that excess providers would require in order to underwrite a policy?
Yeah, I would say there's not a minimum number of covered lives. I will say there is a minimum premium typically associated with these insurance contracts. And so now typically a smaller provider group, particularly if they're just getting into risk and has the potential, typically that's an appealing client for a potential insurer, or for an insurer, because if they're just stepping into downside risk and they might be growing in the future, certainly you like to build a relationship that has the potential to grow going forward. So I would say typically there's no minimum membership. There is often a minimum premium, but there can be flexibility even with minimum premium when there's potential to grow going forward.
Great. Okay, next question here. To what extent, if any, is the trend of the risk entity's HCC or RAF score important?
The trend, I heard HCC, so I'm thinking risk scores, so a trend in risk scores. So what I'm thinking about here is, let's see, if I'm the underwriter and I'm evaluating how I think this provider's risk is changing over time, then that's very important. So if the provider has given me historical data and that historical data is based on, say, a risk score of 1.0, but we know that next year the risk profile changed and the average risk score is going to be 1.2 instead of 1.0. Well, then I would, as the underwriter, I would conclude that historical data is understated by about 20%. So it would be appropriate to increase those claims to reflect the projected risk score of 1.2. It could go the other direction. It could be that the historical data was on a 1.8 risk score and that in the future we expect a 0.8. In that case, about 20% high or 25% high. So then, the opposite type of adjustment would be appropriate. It's also possible to calibrate the rating model to the member, or to the specific provider's population. So we talked about the experience rate and the manual rate. So to the extent that HCC or that risk score information is available, that can also be used to help calibrate that rating manual, because certainly the rating manual, absent any adjustment, is based on a national average. And so to the extent that the provider's own population, I mean, a great example of this would be dual eligibles. If you're a provider and you have a risk sharing contract with a Medicare Advantage plan, and that Medicare Advantage plan has D-SNPs, often we will, as underwriters, we will take that D-SNP population and look at it separately from the general enrollment Medicare Advantage members, and often charge often quote a higher rate for the D-SNP members because they tend to have a higher risk score, they tend to have a higher number of catastrophic claims. I hope that addressed the question.
If that didn't address your question, then email us and we'll make sure to specify to your answer. Okay, next question here is, what about litigation exposure risk?
So from the standpoint, the provider access policy generally will not have anything to do with litigation exposure risk unless, and correct me if I'm wrong here, Rick, unless somehow that risk is attributed to the adjudication of the claim itself and flows through the medical. So it doesn't, and maybe I'm reading too much into this, but it doesn't react, or it doesn't provide any coverage for typically any extra contractual obligations or P&C-ish type litigation exposures that aren't directly related to the adjudication of the claim itself. You want to add anything else to that, Rick?
No, I think you've covered it.
Great. Okay, next question here is, what factors would a risk entity consider when evaluating the pros and cons of a 2 to 4% experience refund versus self-insuring?
Let's see. So the experience refund provision. Okay, so let's talk about self-insuring. Self-insuring, I think, is appropriate for providers to consider when they, do not have capital. They don't anticipate having capital strain. So if you think about, okay, what is a reasonable range of catastrophic claims that I could experience in the coming year? If let's say I believe that 99% of the time, it's going to be less than $10 million. then the question would be, do I have the capacity to absorb $10 million of downside in addition to expected? If I do, then I probably can self-insure. If I'm concerned about an extra $10 million above what I expect, then that might, maybe I should consider either going with, the payer option or purchasing on the commercial market, having some type of protection. When it comes to an experience refund, I view this as separate from that decision. I view experience refund as a question of, is it worth paying a little bit more when I purchase this policy? So about 2 to 4% is typically a surcharge. Is it worth paying a little bit more when I purchase this policy, so that if I happen to have a really good year, I get some of that premium back? An often complaint that an underwriter hears is, well, I'm just not making any money on this. And I guess that my first response to that is, well, you're not going to make money on it in the long run, because you're purchasing a product that has a value, and there is, the reinsurer needs, or the insurer needs to make a profit too. So you shouldn't expect to make money. However, there certainly are years. It's a volatile coverage. So there certainly are going to be some years where catastrophic claims are low. There's certainly going to be some years where catastrophic claims are high. And by purchasing this extra experience refund provision, which costs a little more upfront, then when you have a low claim year, you get some of that premium back. Now, I will say underwriters aren't perfect, so it's possible that it could be mispriced. It's possible that the price could be wrong the first year. So if it's a new coverage, a provider newly taking risk, it's possible the underwriter makes a mistake. Certainly we all make mistakes. So in the first year, if there's concern that the underwriter is pricing it too high, an experience refund provision can be a way to try to hedge against that a little bit. There's also the possibility that the underwriter is going to price it too low, in which case maybe you do make money on it. And typically it takes a couple of years before the run-out period is long. So you're typically pricing the second year before you even know what happened the first year. So if there is a mispricing risk, it typically takes a couple of years for that to become known. So there's definitely a possibility for error. I would say an experience refund provision is one way to address that.
Great. We have time for just a couple more questions here. Next question is, and this is kind of a multi-part question, is how do you know when the deductible is met during the performance year? And is this dependent upon real-time reconciliation between the benchmark and spending during the year? Great question.
So it sounds like the questioner is contemplating aggregate coverage, actually, if I'm reading that into that question. So if you were tracking, say you're in July, month 7 of a 12-month performance year, and you're saying, okay, my benchmark is $1,000 PMPM, and I'm at 1,100 PMPM. If you've purchased aggregate coverage, you might accrue for, and in that case, the deductible, you could say the deductible is 110% of expected cost. In that situation, you might be able to accrue for a potential insurance receivable, but I don't think the insurance carrier would typically pay out until the end of the year. And that's on an aggregate coverage. Most of the remarks today were focused on, so aggregate coverage is available, but the availability of aggregate coverage is much more limited than specific coverage. I don't think there's even a handful of carriers that will offer aggregate coverage, and typically they only offer it to CMS programs like ACO REACH, MSSP, and so on. Whereas the specific excess is available, there's a broader, there's a greater number of insurers that are willing to write that coverage, and will also write it on all lines of business in addition to just the CMS Medicare lines.
And the same individual actually has a follow-on question that says, relatedly, how often are interim reconciliation reports drastically different than final reconciliation, thinking about MSSP and ACO REACH?
Yep. So let's see. The larger the ACO, the less likely that there's going to be variation, because the larger the ACO is, the more the fewer months it takes to get a credible sample of what you think is going to happen. So that's one consideration. Another consideration would be in that aggregate cover, are you or are you not backing out large claims? So often when you purchase an aggregate coverage, you're purchasing a specific coverage along with it. So if there's a specific excess component that says, first of all, we're covering, any claim above $250,000, we're covering at 90%. Typically, if you're also purchasing aggregate, the aggregate cover would say 110%, the attachment point is 110% or 105 or 103% of expected, but we're going to exclude anything that triggered a specific claim. Anything that's a specific claim does not accumulate towards the aggregate deductible. If that provision is in there, it's much less likely that you would have a difference between your interim report and your final report. And the same goes for the CMS reconciliation. I'm actually not as familiar. I personally don't underwrite aggregate coverage, at least not in this market. And so I'm not actually familiar with whether CMS's own interim reports take the truncation into account. I would expect that they would, but if you've elected the CMS truncation, then that would make that interim report less volatile as well.
Okay, I think we have time for one more question, and there's a lot of really good ones that came in. So thank you, everyone, for submitting. But this last question is, how are population-based payments addressed for those not yet using services or delayed access given disparities?
Could you say that? Could you repeat that, please?
Sure. How are population-based payments addressed for those not yet using services or delayed access given disparities?
Population-based payments for those not. So, my initial response is to, I will admit that I do not completely understand the question. My initial response would be to say that for specific excess coverage, a population-based payment likely would not constitute a claim, likely would not constitute a medical claim. So if we're talking about, for example, like let's say a provider is contracted with a payer, they're taking risk, and let's say that they've entered into some kind of subcapitation arrangement for behavioral health services, as an example. So, and I don't know if that's what I meant by population-based payment, but let's say this is the direction I'm going to go. So let's say you've got, the provider says, you know what, we're gonna redelegate or subcapitate a separate entity for behavioral health services. The typical provider excess coverage would carve that out. They would say, okay, well, you're not at risk for behavioral health anymore. You've carved that out by delegating that to somebody else. So we're not gonna cover that. So that would be excluded from. That would not be relevant to the excess coverage. I don't know, Scott, if you had if that was triggering any other thoughts for you on.
No, I think you. I was kind of leaning in the same direction as you. But to the extent for the individual that submitted it, if you want to provide a little bit more context, now that you've heard Rick's response, and send an email to Rick or myself, we'll give it further consideration and try to give you a better answer if we didn't hit the mark.
Awesome. Well, unfortunately, we are out of time. So wanted to thank you all for joining us. Thank you, Scott. Thank you, Rick, for a great presentation. As we close out, I wanted to invite you all to visit vbcexhibithall.com and check out the Summit Re booth there. They have a lot of great resources and information that you can read up on them and sort of what they're doing, and keep tabs on them and contact them as well. And also, and finally, again, I wanted to thank our speakers. If you'd like to reach out to the team, to Summit Re or to Scott or Rick, their information is here on the slide. Feel free to do so, and or you can reach out to me, and I'm happy to facilitate an introduction. Also, I dropped the link to the first part into the chat here, but we'll also include that in the email, and the thank you email that we're going to send you soon with the link to today's recording and the slides. So thank you everyone again for attending, and hope you join us in the future for another webinar. Have a wonderful rest of your day. Bye-bye.